Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It's June 27th. It's the last week of June of 2022. We've been having a really real big heat wave here in Florida. I don't know if you guys have been having it too, but if you have, let me know. Send me an email. I'm curious to know how the weather's been around your neck of the woods. And if you've been benefiting from these comments, these feedbacks, and trying to keep you out of trouble, please let me know as well. That's support@marketgeeks.com. We had 10 out of 11 bearish weeks. Can you imagine that? So I'm hoping that this is going to be the first week, or actually the second week, because Friday was a really huge day. Hoping that this is going to be the second up week because we really need one. And it also looks like things are starting to turn. Remember, before we get deep into my analysis, I'm going to remind you of something. The Fed data that we're getting right now, the CPI and all of that, it's delayed. There's a little delay to all of it. And the markets are forward looking. So you have this data coming in a little late, and markets are always discounting in what's known. So it looks to me like we're about halfway done, or a little bit more than halfway done through this gyration that we're seeing with the market. And I think the market's going to start looking for more upside in the second part of it. So we're not out of the danger zone just yet, but I believe the worst potentially could be behind us, or we're gyrating near the lows or very close to it. I don't think we're going to have another 20%, maybe 3%, 5%, but I think the worst potentially is behind us. It's really impossible to time the bottom, but it's not as hard to test or to time the range. And I think the range is telling us, unless something really unforeseeable happens, I think we're near the lows, or kind of near that circling the lower end of the range. There's too many things going on that were not going on when this thing started, which is a real important key here. And markets are getting more efficient by the day. So you've got the NASDAQ up about 70 points. The Dow is up about 114 points. As I mentioned last week, cyclically, this is a pretty strong period for the Russell 2000, and the first week of July is a very strong week for the S&P. So we may, and that's a 75 to 68% historic accuracy. So again, take that with a grain of salt, but it tends to be a good, strong period for the market. And one of the reasons is because the Russell gets restructuring, gets reprocessed. New stocks go in, old stocks go out every year last week of June. And as far as the S&P 500, it's the 4th of July effect, and that's probably due to a lot of funds putting in institutional money second half of the year. Again, I'm just speculating. But the market is up, especially after being up like huge on Friday, huge. So that's a pretty good sign. Let's talk about all the drama we have going on this week. So we've got durable goods orders coming out in about an hour. That'll be a very interesting report. I want to see the kind of demand we have for these orders and whether the numbers is going to be steady or not. I'm hoping the number will be better than expected, or that the report will shrug a negative number. As you can see here, consensus is 0.1, and the range is really wide. Usually when the range is really wide, it means Wall Street has zero clue to what to expect. But the consensus is 0.1. So hopefully we'll get that. We got a pending home sales index, not a huge report. International trades in goods and services is huge. Consumer confidence is massive, especially before the GDP report. Finally, they're putting it in a good spot. And then we have the GDP report, which will tell us if the economy is starting to heat up again or if it's really cooling off. And the range has been just all over the place. And then you have Mr. I'm not going to predict the future. Oh, wait till I can. Powell speaking afterwards. So consensus is pretty grave, negative 1.4. And the range isn't all that high. Looking for personal consumption expenditures, to me, this is going to be huge. I'm hoping the number is high because if people keep spending, that's a very positive sign for the economy. Then you've got jobless claims, personal income, and manufacturing. But again, the big report is going to be the GDP. And typically, I don't know, things are totally different than they usually are this year. I mean, all the classic signs everything is upside down. But the market typically gets subdued on a Tuesday ahead of the GDP. Not sure if that's going to happen with the consumer confidence report coming out, but I could tell you one thing. We're going to have a tumultuous, volatile, and probably more than likely a week that has a lot of volatility. Now, keep your eye on the bond market. The more this bond market can stay within this range right here without breaking really sharply lower, the more confidence the bond market is gaining into the fact that the interest rates are not going to go that much higher in the near term, that they're actually going to stay where they are. Look at this. Notice the T-bond. If you notice, the T-bond started breaking down right around the same time within a few weeks of the stock market. And as it's been going down, the stock market's been going down. And as it's generating a sideways bias, the stock market has been generating a sideways bias. It's not a coincidence. The stock market gets its directional bias from the bond market, and this is the long bond, and it's anticipating or assimilating everything that's known. And when the Fed was talking higher rates, higher rates, higher rates, it was going down. It's got an inverse relationship to interest rates. But look, it's been going sideways now for over 2 months. And when the Fed said 8.6 inflation, it fell out of bed, but then boom, it came back in. So the more sideways or possibly even upside trading action we can get, that means there's less of a chance that the Fed is going to go crazy with their Fed increases, and there's a good chance they're going to slow it down. Another positive sign, as I've mentioned, the fact that volatility is actually going lower. And that's very, 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 very positive. Let's talk about global economy. And also, the last 5 days, look at the sectors that have been leading. Consumer discretionary, communication, information technology in fourth spot. That's very, 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 very bullish. And I'll talk about sectors in a minute. Let's talk a little bit about global economy. Leaders of the group of 7 leading economies, Powers pledged financial, humanitarian, and other support for Ukraine. It'd be kind of nice if we did a little more than that, like actually did stuff now. But I think we are doing it on the down low without pissing off Putin and making him claim that other countries are getting too involved, because we don't need a reason for him to make this into a world war, although I don't think he's going to do that at this point unless he's completely crazy. Conferring by video links with the Ukrainian president, they were finalizing a deal to seek a price cap on Russian oil, raise tariffs on Russian goods, and impose new sanctions. I mean, really, we need to be tough on Russia right now. Market seems unfazed by the possibility that Russia may have defaulted on its foreign debt for the first time since 1917, further alienating the country from the global financial systems amid the war in Ukraine. Russia faced a Sunday night deadline to meet a 30-day grace period. It's due on May 27th, my dad's birthday of all times, but it could take time to confirm the default. So we're right now about a month, or we're about 30 days into this default, so we'll see what happens. But 30 days, that's huge, huge, huge. Russell 2000 smaller cap stocks added 3.2%. As I mentioned, this is a cyclical time for the small cap stocks. They get re-rotated in the Russell, and that's a lot of stocks going in and out, so they tend to move higher. We're still below the 20% record, so we are still in a bearish market. But on Friday, NASDAQ gained 3.3%, Dow gained 2.7%, Russell gained 3.2%, very significant. Now, the International Monetary Fund on Friday downgraded its forecast, but the market still went up in 2022 to 2.9%, down from 5.7% in 2021. When the economy was bouncing back from the pandemic. But it said that U.S. could narrowly avoid recession with careful policy adjustments. And as I said, core CPI did not go higher. It did not go higher. And that's what the Fed uses. Now, let's get into the nitty gritty. If we look at the stock market, which we need to do right now, we got to stay defensive. But there's very little support at these resistance at these areas. And as I mentioned, if we're going to go up, there's a great chance we're going to go back up to this range and undo all the jargon, all the nonsense and all the downside what we got from the 8.6. That 8.6 CPI was just like the worst thing that could happen for the stock market. But I think this was too much too fast, and I think this could have been a shakeout, especially with divergence on the smaller cap stocks. Very important. So I think we're going to come back here to the base, which means we're only about halfway done with this move up. If you look at the Russell, you will see it's looking very similarly. There's just not that much support, or I keep saying support, resistance till we get to this level, the 191 level. And on the spot, on the QQQ, let me go ahead and give you the QQQ. It's that congestion that we had right here. And on the QQQ, we're already at 296. This is at 312, so it's not all that far away from here. But I think the markets are going to go to this level, and then we'll see if we can go higher from there. But this definitely looked like a major spit out, shakeout, just 3 days with all these gaps. That's just too much too fast, and I think the market will have to come back up to compensate for that. So I'm looking for more upside in the near term on the stock market, especially if the Fed data is kind to us this week. As again, we got durable goods today, consumer confidence, and GDP with Mr. I'm not going to predict the future till I get reelected, Jerome Powell speaking. In terms of sectors, let's look at individual sectors. Now, again, cumulatively, and we got to respect the rules, cumulatively, we still have energy, consumer staples, and healthcare utilities, very defensive. Classic textbook defensive right here. But look at the last 30 days. I mean, consumer discretionary, consumer staples, which is interesting, but technology, communication services. Look at energy, basic materials, and utilities are all the way to the last spot. So things are definitely, there's something definitely happening. When we look at it visually, all of these sectors look like they're going through a turnaround. Look at this, nice turnaround here, consumer staples, turnaround here, turnaround healthcare. They all look like they want to go higher, and I'm not seeing any major resistance till we get to that area where we dropped when we had the 8.2. The only thing that's not cooperating right now, which is troublesome, is the energy sector, and we do have some exposure to the energy sector. But I'm going to tell you guys something. If the entire market goes up, the energy sector will go up with it. Or I think this will be the bottom for the time being. We really dropped, which is telling us one of two things. This is a major pullback, or we're having a reversal. If we're having a reversal, there's still a lot of stocks that will go up, even if the market is turning around. But I would rather take a loss on some of these defensive positions and have the market turn around than keep writing energy at the cost of everything else. I'm sure everybody would agree. We're not really going to know if this is it, and I don't think this is it. I think this is a pullback. I think the war's not over. We've got a lot of unforeseeability. I think we're going to regain about half of this, but energy is lagging right now, and everything else seems to be responding really well. Look at utilities. Look at industrial. Look at real estate. Let's see here. Technology is responding well. Healthcare is doing really well. That's the strongest sector right now, but in the near term. But again, keep your eye on this gyration, and I think we're going to get to this level. I'm looking for the market to get to the pre-CPI, that 8.6 CPI that just threw the market out with the bathwater. Just everything went south. That's what I'm keeping an eye on right now. So if we can come up to this level, there's a good chance we're going to hit major resistance and back away. But I'm not seeing anything crazy till we get to that level, especially in light of the major sell-offs that we've had recently. So bond market, keep your eye on the bond market, and let's see if we can regain this sideways structure and possibly even go higher. I'd love to sell the bond market. But again, because ultimately we will go lower if rates go higher, and they are set to go higher for quite some time. But if we can stay in this level, this is telling us, when we go down from a down slope to a sideways slope, it's telling us that things are fundamentally changing. And this is telling us that the long bond cannot ascertain within its price the rate of hikes that the Fed is giving us, and it's moving to a sideways market, which is telling us that we may be done. That and the energy being so bearish, we got to keep an eye on energy. So energy not breaking the low would be interesting. If it breaks the low, again, it's a balancing test. Do we want energy to go higher, or do we want the market to resume its bullish signal? I think we're going to meet halfway in between, and I think energies are going to rally, and I think the market is going to continue showing us some upside for the foreseeable future. Hopefully, we won't get clipped by this nasty GDP, because if we do, then this will just be a reversal, a short-term pullback to the upside. But again, volatility has been cooperating. When markets broke new lows, this did not. When energy broke lower, this did not. So volatility is on our side, bonds are on our side, and I think the market is assimilating most of the nastiness that the Fed is throwing our way. Keep your eye ahead for that GDP and consumer sentiment. Now, What if I said there was a handful of stocks that have pushed higher, all while the broader market has been a complete disaster? Would you believe me? I know it sounds crazy, but because of a brand new breakthrough, we've been able to dominate the markets. So while everyone's blood pressure is running high, trying to guess the future of the economy or even the price of a tank of gas, oh yeah, I know you guys are out there. We've been taking advantage of the single stock game plan and hyper-focusing on one stock. One stock. Click on the link below to learn more about how we can tap into this single stock breakthrough. Tomorrow, strongest sector, strongest stock, weakest sector, weakest stock. You don't want to miss out because remember, things are changing right now, so you want to be on top of all of this. Follow the link to check out single stock game plan. You don't want to miss this out. It's happening, and I want you guys there. It's going to be really, really cool. Markets are turning around, which means more opportunities right now. See you guys later. Send me some comments, feedback, love letters. Support at marketgeeks.com. We've had 10 bearish weeks in a row. I mean, it's been crazy. And our win rate has been over 77%. So we've been doing it pretty good. I'll talk to you guys later, and I'll hit you up on the Telegram channel. Bye.